Welcome to the Deep Dive. If there's one area of life that often feels like trying to navigate a dense, bewildering forest, it's taxes, isn't it? Just full of hidden paths, unexpected turns, and what feels like a whole secret language sometimes. But in this deep dive, our mission is really to hand you the map and compass. We want to cut through that jargon, pull out the most important nuggets of knowledge from our sources today, and give you a real shortcut to understanding how the U.S. tax system truly operates, how the pros navigate it, and importantly, what crucial rights you have as a taxpayer. We've gathered a pretty rich stack of material for, you think of it like key excerpts from a really comprehensive guide for tax professionals. It covers, well, basically everything from the foundational laws governing taxes to specific IRS procedures, compliance standards, and the ethical duties of tax practitioners. So what's on the agenda? We'll start with the legal framework, the basics, then explore the different ways the IRS actually gives guidance and why some guidance matters way more than others. We'll get into the essential role of tax professionals, their ethics, and then arm you with info about your rights and options when dealing with the IRS, from audits to appeals. We'll even touch on some maybe surprising penalties and recent updates really shaping things right now. Let's dive in. Okay, so to really get where our tax rules come from, we have to start with the government structure itself. How do the legislative, executive, and judicial branches each play a distinct but, connected role in shaping the tax system?
Yeah, it's a fascinating sort of dance between the three. You have the legislative branch, right?
Yeah.
Congress. They're the ones who originate tax laws. They draft and enact them, and most of that gets codified in what we call the Internal Revenue Code, or the IRC.
Okay.
Then the executive branch steps in. That's the Treasury Department and the IRS. They develop the regulations and procedures to actually implement those laws. They bring them to life, so to speak.
At the practical side.
Exactly. And finally, the judicial branch, the federal courts, they act like the umpire. They look at the constitutionality of tax laws and interpret how they apply in real-world cases. This whole system, checks and balances, ensures the framework isn't just created, but also administered and overseen. It's constantly being shaped, challenged, It's not static at all. It keeps evolving.
So Congress writes the laws,
Yeah.
IRS interprets. Where is federal tax law mainly codified? I know Title 26 of the U.S. Code, the IRC. But here's what I'm wondering. Does all tax legislation, like every single bit, live only in Title 26? Or do we need to look elsewhere too?
That's a great question. And yeah, it's a common misconception. No, tax legislation actually goes beyond Title 26 sometimes. A really good example is some international financial reporting rules, like the FBAR requirements foreign bank account report. Those are actually found in Title 31.
Ah, okay. Title 31.
Right. And of course, you've got state, city, local governments. They all enact their own separate tax laws, too. Adds another layer of complexity.
That makes me think immediately about tax pros, like enrolled agents, EAs.
Yeah.
Their exam is federal, right? But if state laws exist and they can impact federal reporting, does the EA exam actually cover any of that state stuff?
You've hit a really crucial point there. The EA exam focuses exclusively on federal tax laws and regs. However, state laws absolutely can impact how federal taxes are reported. Think about community property laws in states like California or Texas.
Right, where income is shared.
Yeah. Exactly. Income earned by one spouse might be considered equally owned by both, and that totally changes federal reporting. So while the EA exam doesn't test on state rules directly, EAs have to recognize that interplay in practice. They need to know a federal return might have state-level roots affecting it.
Makes sense, that interconnectedness. And speaking of the FBAR, which you mentioned is Title 31, not 26, who enforces that, and where does the authority really lie? Sounds like there might be a bit of a twist there.
There absolutely is a twist. So the IRS got FBAR enforcement authority from FinCEN, that's the Financial Crimes Enforcement Network, back in 2003. But here's the interesting part. While the IRS actually collects the penalties for FBAR violations, the actual enforcement authority still stays with FinCEN. It's a division of responsibility. FinCEN handles the investigation, determines violations using their financial crime expertise. And the IRS, with its big collection machine, handles getting the money. It's about leveraging specialized skills.
Got it. So IRS collects the cash, FinCEN does the detective work. Clear distinction. Now, the IRS puts out a ton of documents, guidance. For someone just trying to stay informed, what are the key types of guidance they issue? How do we even start sorting through all that?
It can feel like wading through a library, can it?
Yeah.
They issue quite a variety, yeah. Each with a different purpose, different authority level. You've got Treasury regulations. These are the official interpretations of the code published formally in the Federal Register. Very fancy.
Okay, top tier maybe.
definitely high up. Then revenue rulings, they give the IRS's official stance on specific fact patterns. Revenue procedures outline admin practices. They also issue private letter rulings or PLRs for specific taxpayer requests. Technical advice memoranda, TAMs, that's internal guidance for IRS staff, and various IRS notices for new stuff.
Wow, okay, that's a lot. If I'm a taxpayer or a pro, trying to figure out what's truly binding, what carries the most weight, where do I look first in that list?
Without a doubt, final Treasury regulations. They hold the highest authority. They basically carry the same weight as the tax laws Congress enacts. And there are three types. Legislative regulations, highest authority because Congress specifically told Treasury to write the rules on something.
Like a direct delegation.
Exactly. Then interpretive regulations, which are Treasury's official take on the code. And finally, procedural regulations, just outlining admin practices. But those legislative regs, that's Congress saying, IRS, you figure out the details here and your rules have the force of law. Very powerful.
That distinction helps a lot. So final regs are at the top, but how does an idea even become one of these powerful binding regulations? What's the journey like?
It's a structured public process, actually. It starts with proposed regulations put out for public comment. Taxpayers, pros, industry groups can all weigh in. Sometimes they might issue temporary regulations next. Those are good for 3 years, give immediate guidance while the final one's worked out. And then after considering feedback, they become final regulations, binding.
Given how binding they are, can courts ever disagree with Treasury regulations? Even the really authoritative ones, is there a judicial check?
Oh, yes, absolutely. Courts can, and sometimes do, diverge if they find a regulation is, say, unreasonable, or it clearly conflicts with the actual tax law Congress wrote. It acts as an important check on the executive branch's power, keeps Treasury and the IRS within the lines drawn by Congress, reinforces that Congress makes the law, ultimately.
That makes perfect sense.
Yeah.
Now, a lot of us probably turn to IRS publications first for tax questions. They seem official, they're right there on the website. Are they actually reliable enough to protect you from penalties if you follow their advice?
This brings us to a really crucial warning tale, the Bob Rowe case. It's famous for this. See, he actually did follow guidance in an IRS publication, but the tax court ruled against him because the publication was incorrect. The court said he should have relied on the actual tax law and regulations, not the simplified publication. It highlights a critical point. IRS publications, for instructions, they do not count as substantial authority to protect you from accuracy penalties.
Wow.
Yeah. They're helpful overviews, maybe, but they're not a legal shield. If it's something important, you really need to dig into the law, the regs, or talk to a qualified pro.
That is a powerful warning. So you literally can't just rely on the IRS's own pamphlets for solid legal protection. Big takeaway. Now, speaking of internal IRS stuff, what's the Internal Revenue Manual, the IRM? Is that just for IRS employees, or can we actually see it?
The IRM is indeed their big handbook,
Yeah.
for IRS employees. Details policies, procedures, operational guidelines. It's their internal rule book. But, and this is pretty amazing, actually, it's publicly available on the IRS website.
Really?
Yep. Full transparency. It's a powerful tool for taxpayers and pros. You can get insights into how the IRS works internally, understand their procedures, maybe even cite it when talking to them.
That is remarkable transparency for a government agency. Almost like a secret weapon for taxpayers. Okay, moving on to who can actually represent you before the IRS. It might not be who you think. Before we list the roles, what exactly is practice before the IRS? The Loving case really changed the definition, didn't it?
It absolutely did. A landmark case. Loving fundamentally established that just preparing a tax return by itself does not equal practice before the IRS. That ruling significantly limited the IRS's power to impose educational requirements on all preparers. Drew a very sharp line. Preparing is one thing. Representing you in an audit, that's practice.
That distinction seems critical. And here's where it gets, well, really stark. What did the Sex v. Hawkins case show about the impact of Loving? Did it clarify things further, maybe surprisingly?
Well, Sexton v. Hawkins dramatically showed just how big the Loving impact was. Get this. It showed that even a disbarred lawyer with felony convictions could still prepare tax returns.
Wow.
Yeah. Because of the limits Loving placed on IRS oversight of preparers, it highlights that sharp distinction. IRS regulates practice before it, but has limited say over who just prepares returns. Exposed a bit of a loophole, really.
That's a truly potent example of legal nuances. So, given that, who does have the right to practice before the IRS, represent taxpayers in basically everything, with unlimited rights?
Okay, the qualified pros with unlimited practice rights are attorneys, CPAs, certified public accountants, and enrolled agents, EAs. There are others with limited rights, like enrolled actuaries, enrolled retirement plan agents for specific areas. But attorneys, CPAs, EAs, they have the all-access pass, can represent taxpayers in all matters before the IRS audits, appeals, collections, everything.
And who inside the IRS keeps an eye on these professionals? Are there different offices for different oversight jobs?
Yes, two key offices with distinct roles. First, the Office of Professional Responsibility, OPR. Think of them as the IRS's internal ethics police for the main practitioners, attorneys, CPAs, EAs. They investigate misconduct, can suspend or even disbar practitioners for violating Circular 230, the main rulebook. Their reach even includes appraisers and some unlicensed folks giving tax avoidance advice.
Okay, OPR for conduct. What's the other one?
The other is the Return Preparer Office, RPO. The RPO manages things like issuing PTINs, that's the Preparer Tax ID number. They run the annual filing season program test, and they oversee continuing education for tax return preparers more broadly. So OPR is about conduct, RPO is more about credentials and education for the wider group of preparers.
That's a clear split. What about preparers who aren't EAs, CPAs, or attorneys? Can they represent clients at all?
They can join the annual filing season program, the AFSP. It's voluntary. They take a test, do some continuing education to show competency. But, and this is key, they have limited practice rights. Generally, they can't represent clients before appeals officers, revenue officers, or in collections. Their representation is usually just limited to questions about returns they actually prepared.
Okay, so many acronyms. PTIN, EFON.
Yeah.
What's the difference between a PTIN and an EFN? They sound similar, but must do different things.
They do. A PTIN, Preparer Tax Identification Number, identifies any paid tax return preparer. If you get paid to do returns, you need one. Attorneys, CPAs, EAs need one if they prepare for compensation. One exception is an attorney who isn't preparing returns for pay. An EFI, Electronic Filing Identification Number, is different. That authorizes a person or business to electronically file returns for taxpayers. So PTIN identifies the paid preparer. AFIM authorizes e-filing.
Got it. Personal ID versus the e-filing pipeline. What guides the ethics for all these practitioners? Where's their ethical rule book, and what happens if they mess up?
The ethical bedrock is Circular 230. That's the fundamental publication for practice before the IRS. It covers, well, everything. Who's eligible to practice, detailed conduct rules, disciplinary procedures, competent advice standards, disclosure rules, penalties. It's the comprehensive guide to professional conduct.
And within Circular 230, what does due diligence actually mean for a practitioner day to day?
Due diligence means really paying careful attention to accuracy and completeness in everything submitted to the IRS. Not just filling forms, making sure it's right. It also means using reasonable care when relying on info from others, making sure it looks complete, consistent. And beyond that, professional best practices, clear communication with clients, establishing all the facts, knowing what's important, giving advice based firmly on the law. Integrity and fairness are key.
Okay, this raises a practical question. What about audit lottery advice? Can a practitioner tell a client, yeah, take this position, the chance of audit is super low?
Absolutely not. Circular 230 specifically prohibits that. Practitioners cannot advise clients to take tax positions based only on the low chance of getting caught in an audit. Advice has to be based on the merits of the position, the applicable law, not gambling on audit odds. It's about compliance, not just dodging detection.
Protecting client info is obviously huge, especially with sensitive tax data. What are the key rules in Section 7216 about privacy, and what are the consequences if they're broken?
Section 7216 lays down really strict privacy rules, goes way beyond general confidentiality. It explicitly forbids unauthorized disclosure or use of taxpayer info for any purpose other than preparing the return. And the stakes. They're incredibly high. Violations can lead to severe criminal and civil penalties. It's a very serious rule.
Are there any exceptions at all? Times when a preparer can disclose info without getting into trouble?
Yes, but they're very narrow. Disclosure is mandatory if there's a proper administrative order, summons, or court subpoenas. There's also protection for good faith disclosures if, say, they uncover criminal activity while preparing a return and report it. And limited disclosure is okay for consulting with attorneys or even IRS folks, but only for getting tax advice or clarification related to that specific return. Very limited exceptions.
Makes sense. What about sharing info with related taxpayers, like an estranged spouse or maybe an adult child? Can they just get the info automatically?
That's a common trap. No, info cannot be automatically shared with estranged spouses or adult children without proper authorization. Even if they're related, you still need specific permission. Family ties don't override Section 721 state. Formal authorization is key.
What happens if a client passes away? Who gets their tax info then, and what does the tax pro need to do to handle that correctly?
If a client dies, the fiduciary or executor of their estate can access the info. But, and this is crucial, they need certified proof of their authority. Usually that means getting a letter testamentary from the probate court, proving they have the legal right to act for the estate. The tax pro must verify this documentation carefully before releasing anything. Protects the deceased's privacy.
Beyond advice and disclosures, what about just keeping records? Are there rules for practitioners on how long and what they need to keep?
Yes, very specific rules. They have to keep copies of prepared returns, or at least detailed lists of them, and they must retain client records for a minimum of 3 years after the return period closes. Critically, they also have to return original client records promptly if the client asks, ensures a paper trail and client access.
And lastly, on the pro side, fees. What about contingent fees? Can a tax pro charge, say, a percentage of the refund they get for you?
Circular 230 is clear here, but it's a bit nuanced. Contingent fees are generally prohibited for preparing an original tax return. You can't charge based on the refund amount for just doing the annual filing. However, they are allowed in specific situations, like representing you in an audit, handling an offer in compromise, or in court proceedings where the outcome is uncertain and tied to their efforts. So, distinction between initial prep and later representation or problem solving.
That's a really critical distinction. Okay, we've covered the rules for pros. Let's switch to navigating IRS processes, and most importantly, your rights as a taxpayer. If you need help with the IRS, maybe you're facing an audit, how do you formally authorize someone to represent you? What's the official way?
The main form for that is Form 2848, Power of Attorney and Declaration of Representative. This form lets you authorize up to 4 representatives. It spells out exactly what they can do, which tax years are covered, specific actions allowed. It's your official permission slip. And importantly, the representatives have to sign it too, acknowledging they're bound by Circular 230 rules.
And once Form 2848 is filled out, how do you get it to the IRS? Is it still old school mail and fax, or are there easier ways now?
Thankfully, yes, there are easier ways. You can submit it online through tax professional accounts or upload PDF versions directly, much faster. But yeah, traditional mail and fax are still options if needed. They've tried to make it more streamlined.
Nobody wants an audit, obviously, but it happens. What are the odds, really? And how does the IRS pick returns? Is it random, or is there a method?
Well, the IRS audits only about 1% of individual returns each year, so the chances are relatively low, but definitely not zero. And it's not random. Selection includes looking at potentially abusive transactions, but a big part is computerized scoring DIF scores. These aren't random either. They're complex algorithms that compare your return to statistical norms, flagging things like unusually high deductions or discrepancies. It's like an automated red flag system. They also use information matching, comparing your return to data from employers, banks, etc. And yeah, higher income levels or claiming certain credits like the EITC can increase the audit probability, statistically speaking.
If you are selected, what kinds of audits might you face? It's not just one type, right?
No, definitely not one size fits all. There are 3 main categories. Most common are correspondence audits done entirely by mail. They send a letter asking for documents. Then office audits, where you have to go to an IRS field office with your records. And the least common but most intensive are field examinations, where an IRS agent actually comes to your home or business.
That's helpful to know the range. And what are your basic rights if you get that audit notice? What should you know you're entitled to?
You have crucial rights: the right to professional and courteous treatment, privacy protections, and importantly, the right to representation. You can represent yourself, sure,
Yeah.
or you can have a qualified an EA, CPA, or attorney represent you. And here's a key protection. If you start representing yourself but get uncomfortable, you have the right to stop the examination to go find professional help. The IRS has to give you reasonable time for that. You don't have to go it alone.
That's a huge protection.
Yeah.
So say you go through the audit, you disagree with the result. What's next? Is there an internal appeal before court?
Yes, a very important internal step, the IRS Appeals Office. It's designed as an independent organization within the IRS, separate from the audit team. Their goal is fair, impartial resolutions. It's a key way to dispute findings without immediately going to court. They act kind of like a mediator.
How does that appeal process usually kick off? What's the first notice you might get?
It usually starts with a 30-day letter. This letter proposes the changes from the audit and gives you 30 days to respond and ask for an appeal. Very important. Appeals need to be based on tax law. Just saying I disagree or making more arguments won't work. You need a legal basis.
And then there's another, even more critical letter. What's the 90-day letter, and why is it so time-sensitive? What happens if you miss that deadline?
The 90-day letter, also called a notice of deficiency. This is the final warning before the IRS can legally assess the extra tax. It comes if you don't respond to the 30-day letter or if appeals don't work out. That 90-day deadline is absolute, non-negotiable. If you miss it, you lose your right to go to U.S. tax court before paying. The IRS can start collection immediately. 1 day late, and that door to tax court closes. It's a hard stop.
Okay, do not miss the 90-day letter deadline. Got it. So if you want to fight it in court, do you have to pay the tax first? Or is there a court where you can challenge it before paying?
That's the huge advantage of the U.S. tax court. You can challenge tax deficiencies there without paying the disputed amount first. That's a major difference from U.S. District Court or the Court of Federal Claims. Those usually have a pay-to-play rule, pay first, sue for refund later. Tax court avoids that hurdle.
What else should we know about the tax court? Does it set precedents, for instance?
Yes, it does. Tax court handles a wide range of disputes: income, estate, gift taxes, and its decisions absolutely set binding precedents. A ruling in one case can shape how the law is applied in many similar cases going forward. It really impacts the tax landscape.
Okay, so if things progress and the IRS moves to collect debt, what are tax liens and levies? How are they different?
They're distinct, yeah. A federal tax lien is a legal claim against your property, current and future. It's like a public notice to other creditors that the IRS has first dibs on your assets, attaches to almost everything. A levy is the actual seizure of property, taking money from your book account, garnishing wages, seizing Social Security or retirement income. Now, while the IRS can levy, they often prefer voluntary payment plans. Less hassle for them, usually.
Can they take literally everything? Are there any protections against levies?
No, thankfully, the law exempts certain things to protect basic necessities. Essential clothing, school books, tools you need for work. Also, certain income sources like unemployment benefits, workers' comp, some pensions, supplemental security income, even undelivered mail that can't leave you completely destitute.
What if you filed jointly, but your spouse caused the tax problem, maybe without you even knowing? Are you stuck with their debt, or is there relief?
That is exactly what innocent spouse relief is for. It's a really crucial provision. It can release one spouse from joint tax liability tax, interest, penalties on a joint return. This is vital because filing jointly means joint and several liability. You're both 100% responsible for the whole amount, regardless of who earned it or messed up. And importantly, even a divorce decree doesn't stop the IRS from coming after both of you for joint debt. Innocent spouse relief is the way to legally separate yourself from that IRS liability.
Sounds like a critical safety net. What are the 3 types of innocent spouse relief? How do they differ?
There are 3 main flavors. First, traditional innocent spouse relief. That's for unreported income or bogus deductions your spouse took that you didn't know about and had no reason to know about. Second, separation of liability relief. This actually divides the extra tax owed between spouses based on who was responsible for which errors, usually for divorced or separated couples. Third, equitable relief. This is kind of a last resort if the other 2 don't fit. Maybe the tax was reported correctly but just not paid, and paying it now would cause severe economic hardship. Think terminal illness, major caregiving duties.
That's a clear breakdown. Now, how is injured spouse different from innocent spouse? They sound alike but do different things, right?
Totally different, yeah. Confusing them is easy but problematic. Innocent spouse is about relief from liability for tax problems you didn't cause on a joint return. Injured spouse claim is about protecting your share of a tax refund from being taken to pay your spouse's separate debts. Things like their old tax debt from before marriage, child support, student loans. You use Form 8379 for injured spouse. So, innocent liability relief, injured refund protection. Also, state rules vary on injured spouse claims.
Okay, what if you just absolutely cannot pay your tax debt? Explored all the options. Is there any way to settle with the IRS for less than the full amount?
Yes, there is a formal process. It's called an offer in compromise, or OIC. It's a formal agreement to settle your tax debts for less than what you fully owe. The IRS considers it if there's real doubt they can collect the full amount or doubt you actually owe it, or under exceptional hardship circumstances.
But I've heard the rejection rate for OICs is really high. Why is it so strict? Seems like a lot of people might need it.
It is strict. About 2/3 get rejected. Because, well, it's a big deal for the government to agree to take less money than owed. You have to fit into one of the specific categories. Doubt as to collectability, proving you truly can't pay now or foreseeably based on a deep dive into your finances. Doubt as to liability, a genuine dispute that you owe the tax at all. Or exceptional circumstances, proving severe economic hardship like a terminal illness making payment impossible. It's not just a payment plan alternative, it's a last resort for really tough situations.
Does filing bankruptcy just wipe out tax debt, or is it more complex?
Definitely more complex. Filing bankruptcy does trigger an automatic stay, which immediately stops IRS collection efforts. That's helpful. But getting tax debt discharged depends on meeting 4 strict timing rules. The tax return due date was at least 3 years ago. The return was actually filed at least 2 years ago. The tax was assessed at least 240 days ago. And crucially, no tax evasion involved. Plus, bankruptcy tolls pauses the IRS's collection clock. So it stops collection temporarily, but doesn't always erase the debt permanently.
Incredibly detailed and good to know. Okay, let's shift to modern tax stuff. How has e-filing changed the game for tax prep?
Oh, it's completely transformed it. Over 84% of taxpayers e-file now. Why? Faster processing, quicker refunds, generally better accuracy because the software catches simple errors. But even with e-filing, you, the taxpayer, are still fully responsible for the accuracy. And for preparers doing more than 10 individual returns a year. E-filing is mandatory now. It's efficient, but accuracy is still paramount.
What happens if an e-filed return gets rejected by the IRS system? What's the process then?
Very specific rules apply. The preparer has to tell the taxpayer within 24 hours, provide the reject codes, explain why. The IRS gives perfection periods, usually 5 days for individual returns, 10 for business to fix the errors and resubmit without needing a new signature if the changes are minor. But if a return gets rejected right on the due date, crucial step, cancel any scheduled electronic payment immediately, then print it out and paper file with original signatures to make sure it's considered timely.
Tax identity theft. Huge concern now. What are the basics we need to know about this threat? How is it different from other ID theft?
Yeah, tax-related identity theft is when someone uses your personal info, like your social security number, without permission for fraudulent tax purposes. It's a massive priority for the IRS. It's different from, say, employment ID theft, using your SSN for work, or general refund fraud, filing fake returns for refunds. Tax pros have a big responsibility here to safeguard client data and verify identity. And the IRS has tried to make it easier for victims by improving the electronic submission for Form 12039, the Identity Theft Affidavit, helps speed up resolution.
Speaking of ID, what about ident taxpayer ID numbers in these certified acceptance agents, CAAs? What's their role?
Right. CAAs are professionals authorized by the IRS specifically to authenticate passports and birth certificates for people applying for an ITN. This is a huge help because it means ITN applicants don't have to mail their original valuable documents like passports to the IRS. Reduces risk, hassle. CAAs get special forensic training to do this verification properly. It's a vital service for folks who need to file U.S. taxes but don't have a social security number.
Let's wrap up with some recent legislative changes impacting taxes. What are some big ones people should maybe be aware of?
Okay, several significant ones lately. The Inflation Reduction Act of 2022 brought big changes to energy credits, trying to boost green energy. The further Consolidated Appropriations Act of 2024 actually resulted in a reduction in IRS funding, which could impact their operations. The Secure 2.0 Act of 2022 made major changes to retirement plans affecting RMDs, Roth options, lots of things. And a really big one for businesses is the Corporate Transparency Act. Now requires many companies to report their beneficial ownership info to FinCEN, aimed at fighting money laundering.
And what's the very latest on those 1099-K reporting thresholds? For payment apps, online sales, that's been super confusing.
It really has been a moving target. The American Rescue Plan Act tried to lower the 1099-K threshold to just $600. Huge change. But the IRS has postponed enforcement of that low threshold, citing implementation problems, public feedback. They're now talking about a higher threshold for the future. Maybe $5,000, maybe $10,000 is being discussed. Key thing, though. Personal transfers, gifts, reimbursing friends for dinner via Venmo, those are explicitly excluded. It's not meant to capture casual personal payments.
That's a relief for many. Okay, finally, this sounds a bit scary but important. Passport revocations for tax debt. Can the IRS really stop you from traveling?
Yes, they absolutely can. It's a serious consequence. If your tax debt goes over a certain amount, currently $59,000 in index for inflation, the IRS can certify that debt to the State Department. And that certification can lead to your passport application being denied or your existing passport being revoked or limited. It can literally ground you internationally until you deal with the tax debt.
Wow. Well, we have certainly journeyed through an intricate landscape today. U.S. tax law, IRS guidance, the roles and ethics of tax pros, and, maybe most importantly, your rights and options as a taxpayer facing audits, collections, or needing relief.
Yeah, the goal really was just to equip you with knowledge to navigate this, well, often complex system with a bit more confidence. Understanding these details hopefully empowers you to ask better questions, advocate for yourself, or know when and how to choose the right professional help. It's about being informed, not intimidated.
Absolutely. And as we've seen, the IRS system, complex as it really is designed with this balance of enforcement powers and taxpayer protections. So, given the constant evolution of tax law, the rise of digital interactions, all these nuances we talked about, here's something to think about. What steps will you take going forward to ensure you're not just compliant, but truly informed and protected in your own tax endeavors?